Have you ever stared at your trading screen, covered with colorful indicators, and still had no clue what to do next? You're not alone. Every day, thousands of traders chase signals, wait for confirmations, and pray their perfect setup finally works, only to end up frustrated, confused, and broke. I know that pain because I've been there. For years, I believed more indicators meant more accuracy. I thought I was being smart by using every tool I could find. But the truth? The more indicators I added, the less confident I became. My screen was full, but my mind was empty. This video is for traders who are done guessing. It's for those who want to see the market the way professionals do. Clean, simple, and powerful. In the next few chapters, you'll learn why indicators keep you trapped, how to read pure price action, and how to think, plan, and execute like an institutional trader. You'll understand that real trading success isn't about predicting. It's about reacting with calm precision. By the end of this video, you'll stop chasing indicators and start thinking like a pro. Because once you learn to see the truth behind the chart, you'll never trade the same way again. Chapter 1. The Indicator Trap. Have you ever opened your trading platform and felt overwhelmed by all the colorful lines, moving averages, RSI signals, and flashing arrows telling you to buy or sell? It looks professional, right? It makes you feel like a real trader. You think, if I just find the perfect combination of indicators, I'll finally crack the code. That's the trap. Most traders fall into it without realizing it. They start innocent, watching YouTube tutorials, joining Telegram groups, and trying new strategies. Each time they lose, they think, maybe I'm missing one more indicator. So they add another, then another, until their chart looks like a Christmas tree. And then, one day, they realize something painful. The more indicators they added, the less they understood the market. That's the irony of modern trading. The tools meant to help you actually disconnect you from the truth. I still remember my early trading days. I had 6 indicators on my chart: moving averages, MACD, RSI, Fibonacci, Bollinger Bands, and a stochastic oscillator. I thought I was analyzing the market like a pro, but every time I entered a trade, one indicator told me buy, another said sell, and the rest just confused me further. I didn't know it then, but I was doing what 90% of traders do: outsourcing my decision-making to lagging tools instead of understanding what the market was actually doing. Here's the hard truth. Indicators don't predict the market. They only reflect what has already happened. It's like trying to drive a car while only looking in the rear-view mirror. You can see where you've been, but not where you're going. Indicators aren't evil. They're not the enemy. They were created to summarize data, to give you a perspective. But they were never designed to replace your understanding of price. The problem starts when traders use them as crutches instead of confirmation tools. You see, the market isn't math. It's emotion. Every candle you see on a chart is the result of millions of traders buying, selling, fearing, and hoping. It's a living story. And indicators can't read emotions. Professional traders know this. That's why their charts often look almost empty. Just price, maybe a volume bar, and nothing else. They've trained their eyes to read what price is telling them. Every high, low, wick, and candle body reveals something about who's in control, buyers or sellers. When you rely too heavily on indicators, you lose that connection. You stop thinking. You wait for a signal instead of seeing the signal. Let me give you an example. Imagine you're watching a movie, but instead of focusing on the story, you keep checking the subtitles for clues about what's going to happen next. You'll miss the acting, the emotion, the subtle shifts in tone, the real story. That's exactly what traders do with indicators. They stare at lagging signals and miss what price is already telling them in real time. The truth is, indicators don't move the market. People do, and people move based on emotion, fear, greed, and herd behavior. Once you understand how those emotions appear on the chart, You won't need 10 indicators to tell you what's going on. So why do traders still cling to indicators? Because they make trading feel safe. It's comforting to think that a mathematical tool can protect you from loss. It gives you a sense of control in a chaotic environment. But that comfort is false. The market doesn't care about your indicator setup. It moves according to liquidity, psychology, and institutional behavior, not your RSI crossover. Think about this. If indicators could truly predict the market, every trader using them would be rich. But 90% of traders still lose. So what does that tell you? It means indicators give you information, not insight. When I finally understood this, everything changed. I stopped asking, what are the indicators saying? And started asking, what is the market saying? I began studying price structure, higher highs, lower lows, support, resistance, and liquidity zones. I started noticing patterns that indicators always missed, like stop hunts, fake breakouts, and manipulation wicks. These were things no indicator could capture because they were rooted in human behavior, not mathematical formulas. And the more I trusted my naked chart, the more confident I became. No more signal hunting, no more confusion. Just clean, clear, confident decisions. But breaking the indicator addiction isn't easy. It feels uncomfortable at first. You'll open your chart and feel naked without those colorful lines. You'll doubt yourself. You'll want to add them back, just for confirmation. That's the withdrawal phase. Your brain is used to the comfort of confirmation. But remember this. Every time you check for confirmation, you weaken your decision-making muscle. Trading is 80% psychology and 20% strategy. Indicators feed your strategy, but they starve your psychology. Here's something most traders never realize. Indicators are lagging. By the time an indicator flashes buy, the smart money has already entered. By the time it says sell, they're already taking profits. You're always a few candles behind, reacting to history instead of anticipating movement. That's why retail traders are always late to the move. They're following indicators instead of flow. They're responding to what already happened instead of why it happened. When you start reading price directly, you get to see why. You see where liquidity lies. You understand where big players might be accumulating positions. You begin to see the traps that institutions set for retail traders who blindly follow indicators. Once you see that, you can't unsee it. Think about it like this. If the market was a conversation, indicators would be the echo, always a few seconds late. Price action is the actual voice. If you want to understand the message, you need to listen directly to the voice, not the echo. That's how professionals trade. They read context, not color-coded signals. When price forms a double top, they don't see two peaks. They see trapped buyers, liquidity pools, and emotional imbalance. When a candle breaks structure, they don't just mark a line. They visualize fear and greed battling for dominance. Indicators can't teach you that. Only observation and understanding can. Let's be real. Removing indicators won't make you profitable overnight. You'll still lose trades, but each loss will teach you something real. You'll see exactly what went wrong instead of blaming your tools. That's when real growth begins. Because once you take responsibility for every decision, you stop being a victim of the market. You become a student of it. And when you become a student of price, the market starts revealing patterns that most traders never see. Here's the crazy part. After a while, you'll start predicting how indicators will move before they move. Why? Because you'll understand the price action behind them. You'll see that the RSI went oversold because of a liquidity grab. You'll know that the MACD crossed over because smart money already shifted direction. At that point, indicators stop being your teachers and become your students. You'll use them not to guide you, but to confirm what you already know. That's when you'll truly feel like a pro trader. So here's the takeaway. Indicators are not the problem. Dependence is. Stop following them blindly. Use them, but never trust them more than your eyes and brain. The market doesn't reward the most technical trader. It rewards the most aware one. Once you remove the clutter, you'll see the market for what it truly is. A battle between patience and panic, between fear and greed. And when you learn to read that battle through price, you gain something no indicator can ever give you: clarity. So the next time you open your chart, take a deep breath. Remove the noise. Ask yourself, if I had no indicators, could I still understand what's happening? At first, maybe not. But over time, you will. Because true trading mastery doesn't come from more tools. It comes from deeper vision. And that vision starts right here. When you decide to stop following indicators and start thinking like a pro. Chapter 2. Price is the only truth. If you strip away every line, every indicator, and every tool from your chart, what's left? Just price. And that's all you'll ever need. It sounds too simple, right? Most traders think price action is too basic. They want something more advanced, more technical, more complex, as if complexity equals accuracy. But the truth is, price is the purest, most honest data in the market. Everything else is just a translation. Price never lies. It reacts. If buyers are stronger, price goes up. If sellers take over, price goes down. Every tick, every candle, every wick is the direct result of human emotion, decision, and execution. There's no filter, no delay, no algorithm twisting the truth. Just raw market behavior. Once you learn to read that, you'll see the market differently forever. I remember the first time I decided to remove every indicator from my chart. I felt completely lost. I stared at the naked candles and thought, what now? I didn't realize it at the time, but that blank chart was the beginning of real trading. Because for the first time, I wasn't relying on anyone else to tell me what to see. I had to see it myself. At first, it was frustrating. I missed entries. I doubted my analysis. But little by little, I began to notice patterns I'd never seen before. Price started to talk. When it formed a higher high, I saw strength. When it failed to make a new high, I saw exhaustion. When a big wick appeared at a key level, I understood rejection. And the more I watched, the more I realized that price was like a living organism, constantly moving, adapting, testing, and revealing its next intention to those who paid attention. Most traders never get to that level of awareness because they're too busy analyzing what happened instead of understanding why it happened. See, price action is not just lines and candles. It's psychology made visible. Every candle represents emotion. A bullish candle shows confidence. A bearish candle shows fear. A long wick shows hesitation. When you learn to see emotion through structure, you unlock an entirely new level of understanding. Let's make it simple. Imagine a strong bullish trend. The market is moving up, everyone is buying, and you start feeling that itch, the fear of missing out. You jump in late, just when everyone else does. Suddenly, price reverses. You panic, you close early. Then it continues upward again without you. Sound familiar? That's not just your story. That's the collective psychology of the entire market. Price reflects that psychology every second. That's why price is the only truth, because it shows human behavior in real time. Once you understand this, you stop fighting the market. You start flowing with it. Price doesn't move randomly. It moves because of structure and liquidity. Liquidity is simply where money is. It's where orders sit. Stop losses, pending buys, pending sells. Institutions know this. They target those areas because that's where they can fill their massive positions. Think about it. When you place a stop loss above a recent high, what are you doing? You're leaving your liquidity in the market. You're showing your hand. Institutions know where retail traders hide their stops, and they push price there intentionally to grab that liquidity before moving in the real direction. That's why you'll often see fake breakouts. Price breaking a key level, triggering everyone's stop loss, and then reversing hard. That's not coincidence. That's manipulation. But once you start reading price correctly, you'll see it happening. You'll understand that price isn't chaotic, it's strategic. Every market move follows a simple pattern: accumulation, manipulation, and distribution. First, smart money accumulates. They build positions slowly while the market looks quiet. Then comes manipulation, sudden spikes or drops to shake out retail traders. Finally, distribution. The real move begins, and the institutions ride it while everyone else is still confused. You can't spot this cycle using indicators. You spot it through observation, through the way price behaves around key levels, the way it reacts to liquidity, and the story it tells with its structure. Price structure is your map. When price breaks a previous high and then fails to hold, it's giving you a clue. When it forms a higher low, it's giving you direction. When it consolidates tightly after a big move, it's preparing for another leg. If you learn to read this map, you'll never need someone else's signal again. One of the most common mistakes traders make is assuming that more data equals better decisions. They pile on news, fundamentals, and indicators trying to find confirmation. But trading isn't about knowing more. It's about seeing clearly. Price gives you everything you need: direction, strength, sentiment, and timing. When you see a sharp rejection candle at a strong level, that's your signal. When you see a clean break of structure, followed by a retest, that's your opportunity. You don't need a moving average to tell you that buyers are taking over. The candle's already told you. And the beauty is, once you start trusting price, trading becomes peaceful. You stop chasing. You stop overanalyzing. You wait, watch, and act when the story makes sense. Here's a simple truth. Professional traders don't predict. They react. They don't need to know what will happen next. They just need to know what's happening right now. Retail traders, on the other hand, are obsessed with prediction. They want to know where price will go, next week, next month, or after the news release. But that obsession blinds them from seeing what's right in front of them: the live behavior of price. When you stop predicting and start reacting to what you see, your trading transforms. You'll stop being early or late. You'll be in sync. It's like surfing. You can't control the wave, but you can read it. If you try to guess when it'll come, you'll wipe out. But if you observe its movement and catch it at the right moment, you'll ride it effortlessly. Price is that wave. You can't control it, but you can ride it if you understand it. Another reason price action works so powerfully is because it forces you to think in probabilities, not emotions. When you trade based on indicators, you think in absolutes. RSI crossed, so it's a buy. But the market doesn't care about your signals. It only cares about the order flow. When you trade based on price, you start thinking, if price breaks this level and holds, there's a 70% chance it continues. If it rejects, I'll cut it. That's professional thinking. You're no longer attached to being right. You're focused on reading correctly. And when you start trading this way, something magical happens. Your confidence becomes internal. You no longer need external validation from indicators or mentors or gurus. The market itself becomes your teacher. Let's talk about one of the biggest mindset shifts you'll experience: patience. When you learn to read price, you realize that the best trades take time to form. You start to value waiting more than trading. You become selective. You start thinking like a sniper, not a machine gunner. Every candle adds a clue, and you wait for the story to align. You don't need to trade every move. You just need to catch the right one. That's how professionals operate. They might take only a few trades a week, but each one follows the market's logic, not their impulse. Price teaches you that patience isn't weakness. It's power. Now, let's address the emotional side. When you learn to trust price, your trading emotions calm down. You stop feeling anxious when you enter a trade because you understand why you entered. You stop panicking during small pullbacks because you know what structure looks like. You're no longer reacting to every tick. You're observing the flow, this emotional stability is what separates consistent traders from impulsive ones. The ability to see the truth in price keeps you grounded. It's like switching from noise to silence. Suddenly, everything becomes clear. The market is always communicating, but most traders don't speak its language. They're too busy chasing tools instead of learning to listen. Price action is that language. It's the raw voice of the market. A sudden spike in volume? That's the market shouting. A long wick rejection? That's hesitation. A tight consolidation? That's preparation. Once you learn to interpret those signs, you don't need translation. You understand fluently. And the best part? This skill never fades. Indicators come and go. Strategies become outdated, but price reading is timeless. It works in every market: forex, crypto, stocks, commodities, because human emotion is universal. So, the next time you look at your chart, simplify. Remove the clutter. Zoom out. Ask yourself, what is price doing and why? Where did it struggle? Where did it break? Who's in control, buyers or sellers? The answers are right there in front of you, not hidden behind formulas. Once you start trading this way, you'll feel something you may not have felt in a long time: clarity. You'll realize trading isn't a guessing game. It's an interpretation game. And when you learn to interpret correctly, you start trading with calm confidence instead of anxious hope. Price is the only truth because it doesn't lie, it doesn't lag, and it doesn't manipulate. It shows you exactly what's happening, if you're willing to see it. So stop trying to outsmart the market. Start observing it. Watch the dance between buyers and sellers. Notice how fear and greed paint every candle. Let price be your guide. Because in the end, indicators can confuse you, mentors can mislead you, but price will always tell you the truth. Chapter 3. The Institutional Mindset. If you've ever wondered why the market seems to move against you right after you enter a trade, you're not crazy. It's not bad luck either. You're just not thinking like the people who actually move the market. Most retail traders believe the market is random or rigged. They think someone somewhere is controlling everything. And in a way, that's true. Institutions, hedge funds, banks, the smart money, they do control the majority of liquidity. But they don't control it through magic, they control it through psychology, patience, and strategy. And that's what separates them from the average trader staring at indicators, hoping for a signal. This chapter isn't about conspiracy. It's about understanding how institutional traders think. Because once you learn to see through their eyes, the chaos of the market starts making perfect sense. When I first started trading, I used to think institutions were the villains. Every time I was stopped out by a sudden spike, I would swear someone was hunting my stop. Every time I saw a fake breakout, I thought the market was out to get me. It took me years to realize the market wasn't out to get me. It was just doing what it's designed to do: move liquidity. Retail traders are like tiny boats floating in an ocean controlled by massive ships. The big players don't even notice us. They're just executing their strategy. But because we're always trading where they need liquidity, we get caught in the waves they create. That's why understanding their mindset is everything. Here's the first rule of the institutional mindset: pros don't chase price. They wait for liquidity. Liquidity is fuel. Without it, price can't move. Institutions can't just enter a trade whenever they want. If a hedge fund wants to buy $500 million worth of USD, they can't hit buy on MetaTrader. That would skyrocket the price instantly. They need sellers, liquidity, to fill their orders. So what do? They create liquidity. How? By manipulating retail traders' emotions. They push price below support or above resistance to trigger retail stop losses and breakout trades. That flood of orders gives them the liquidity they need to enter quietly in the opposite direction. Then, once they've built their position, they let price move naturally. And retail traders are left wondering why the breakout failed again. This is why retail traders lose over and over in the same spots. They're reacting emotionally to patterns that institutions designed to trap them. Let's make this real with an example. You're watching EUR/USD. You spot a clean resistance zone at 1.1000. Price touches it multiple times, and you're waiting for a breakout. One morning, the candle finally breaks above $1,000 with strong momentum. You buy immediately. It feels perfect. Then, within minutes, the price reverses sharply and drops 50 pips. You panic and close your trade. What just happened? Institutions pushed price above resistance intentionally. They knew thousands of traders had stop-loss orders sitting just above that level. Liquidity waiting to be taken. When they broke that level, all those stop-losses became buy orders, giving institutions the liquidity to sell into. Once filled, they let price drop. That move wasn't random. It was planned. And it happens every single day, across every market: forex, stocks, crypto, commodities. The pattern never changes because human psychology never changes. The difference between retail and institutional thinking isn't just in tools, it's in patience. Retail traders want action. They love the thrill of being in a trade. Institutions love waiting. They spend 90% of their time observing and 10% executing. They understand that the best trades come from waiting for the right moment, not creating one. That's why you'll often see markets moving sideways for hours or days. That's accumulation. Institutions are quietly building their positions. The longer it ranges, the bigger the move afterward. Because they've been filling massive orders without moving the market too early. Then comes manipulation. That sudden spike that takes everyone out. Retail traders think the market just exploded out of nowhere. But for institutions, that move is carefully orchestrated. If you really want to think like a pro, you must learn to see intent behind every move. When price breaks structure, ask yourself, who benefits from this move? If price shoots up suddenly in a low-volume environment, ask, who's getting trapped here? If price sweeps the highs and then reverses, think, did that move collect liquidity for a bigger move? Institutions trade based on logic, not emotion. They don't get excited when price moves. They analyze why it moved. That's what separates consistent profits from random wins. Here's something that might shock you. Institutional traders don't even think in entries, the way retail traders do. Retail traders look for perfect setups. A moving average crossover, a candle pattern, a Fibonacci level. They want instant confirmation. Institutions look for zones, areas of imbalance, inefficiency, and trapped liquidity. They build their positions gradually across those zones. They scale in, manage risk, and let the market come to them. That's why they seem so calm. They're not obsessed with being right immediately. They're focused on being positioned correctly. Once I started thinking like that, trading became slower, but more peaceful. I stopped trying to catch every move. I began waiting for the market to come into my zone of interest, the place where I knew institutions might be active. I stopped reacting emotionally and started anticipating logically. That's when my win rate improved. Not because I found a secret strategy, but because I finally aligned with how the real players operate. You can do the same. Now, let's talk about order flow, the language of institutions. Every candle represents orders being filled. When you learn to read those orders, you can see where the smart money is entering or exiting. For instance, a long wick at the top of a candle isn't random. It's rejection. It means price tried to go higher, but large sell orders absorbed it. That's institutional selling pressure. A cluster of equal lows in a downtrend isn't just support. It's liquidity waiting to be taken. Once you learn to see that, trading stops being about patterns and starts being about intent. There's also something powerful about how institutions view losses. Retail traders hate losing. They take it personally. They revenge trade. Institutions treat losses as data. If a position doesn't work, they adjust. They don't attach ego to it. Their focus is on probabilities, not perfection. That's a mindset every trader must adopt. Stop thinking in terms of right or wrong. Start thinking in terms of profitable or not. Professionals know that being wrong is part of the process. Retail traders see one loss and question their entire system. That's why consistency never comes, because their mindset is reactive, not strategic. If you've ever watched how institutional traders manage risk, you'll notice something interesting. They don't risk big. They risk small, but often. Their edge comes from consistency and patience. They don't try to double their account in a week. They focus on small, repeated wins compounded over time. They understand the power of math. That is, 2% a week compounded over a year can outperform a gambler who wins big once and loses everything later. That's the professional way of thinking. Slow, steady, sustainable. Another key element of the institutional mindset is objectivity. Retail traders see what they want to see. If they're biased toward buying, they'll find reasons to buy, even when the market is screaming sell. Institutions don't care. They have no emotional attachment. If the market changes direction, they change with it. No hesitation. That's why pros make money in both bullish and bearish conditions. They're not attached to being right. They're focused on being profitable. Once you free yourself from bias, you start to see the market for what it is, not what you want it to be. Think about this. Most traders spend years looking for a perfect strategy. Institutions spend years mastering discipline. The difference is massive. You can copy someone's strategy in one day, but you can't copy their discipline, patience, or understanding of market behavior. That's what makes professionals different. They don't need to trade every day. They don't need excitement. Their satisfaction comes from executing perfectly, not constantly trading. That's what thinking like an institution really means. Patience, precision, and perspective. There's a calmness to institutional trading. It's not emotional. It's logical. It's like a chess game. They plan moves ahead, not just react to what's happening now. Retail traders play checkers, move by move, reaction by reaction. If you start thinking like a chess player, you begin anticipating where the liquidity might be next, how retail traders will react, and where institutions might step in. Suddenly, the market starts making sense. You're no longer surprised by fake breakouts or stop hunts. You expect them, and when you expect them, they no longer hurt you. They help you. Once you truly internalize the institutional mindset, you'll stop fighting the market and start flowing with it. You'll see manipulation not as unfair, but as opportunity. You'll realize that the market isn't random. It's a perfectly structured psychological machine designed to reward patience and punish impulsiveness. And when you align with that machine, you stop being the prey. You become the hunter. So next time you open your chart, don't ask, where should I buy or sell? Ask instead, where would they buy or sell? Because when you start thinking like them, patient, strategic, and precise, you'll finally stop trading against the market and start trading with it. Chapter 4. Emotionless Execution. Control your mind. Control your money. Have you ever made a trade you knew you shouldn't have, but did it anyway? You saw the setup, felt that tiny voice inside saying, "Don't click it." Yet your hand still moved, almost automatically. And then, just as if the market could sense your impatience, the price reversed and smacked your stop-loss in seconds. You sat there, staring at the screen, angry not at the market, but at yourself. That right there is the battle most traders never win. The battle with their own emotions. The truth is, trading isn't a game of charts. It's a game of psychological control. You can have the best system, perfect entries, and all the technical knowledge in the world. But if your emotions take over at the wrong time, you'll still lose money. The market doesn't reward intelligence. It rewards discipline. When I first started trading, I believed emotions could be eliminated. I thought pro traders were these cold, robotic beings who felt nothing. But that's not true. Even the best traders in the world feel fear, greed, and frustration. The difference is they've trained themselves to not act on those emotions. They execute their plans even when their minds scream otherwise. That's what emotionless execution really means. It's not the absence of emotion, it's mastery over reaction. Let's talk about fear first. The oldest emotion in trading history. Fear shows up in many forms. Fear of missing out, fear of losing money, fear of giving back profits. I remember once being up $800 in a trade. My setup said, hold. The trend is still strong. But my mind whispered, what if it reverses now? So I closed early. 10 minutes later, the trade hit my full target. It would have made 2,400. That's when I learned something painful but powerful. Fear doesn't protect your capital. It just limits your potential. Fear makes traders cut, winners short, and let losers run. It's the reason you move your stop loss just this once, or close early to be safe. But the irony is, those little decisions, those fear-based micro moments, are what destroy consistency. Fear tricks you into thinking you're being cautious when you're actually sabotaging your plan. Then there's greed, the twin brother of fear. Greed whispers, one more trade. You're hot right now? Don't stop. It shows up after a winning streak when confidence turns into arrogance. You start believing you can't lose, that you've cracked the code. So you size up, overtrade, or skip confirmation. And then, the market humbles you. I've seen traders make $5,000 one day and lose $7,000 the next because they didn't stop when they should have. Greed is sneaky because it doesn't feel wrong. It feels exciting, powerful, and justified. You convince yourself that taking more trades means maximizing opportunity. But really, it's just emotional impulsivity disguised as ambition. The pros understand this. They know when to stop. They don't trade out of excitement. They trade out of alignment. Alignment with their system, their data, their plan. And perhaps the most destructive emotion of all, revenge. Every trader knows that one. You take a loss, feel that sting in your chest and think, I'll get it back. But trading to get it back is like trying to drive straight after an accident. You're too shaken to make clear decisions. Revenge trading doesn't come from logic. It comes from ego. It's the mind saying, I can't be wrong. And that single thought has destroyed more accounts than bad analysis ever could. The real shift begins when you understand this. Your emotions aren't the problem. Your attachment to the outcome is. When you stop caring about the result of a single trade and focus on executing your plan consistently, emotions lose their power. Professional traders think in probabilities, not certainties. They know no trade is guaranteed, so they don't attach their self-worth to wins or losses. One trade doesn't define them. It's just part of the process. That detachment is what gives them emotional control. You don't need to be emotionless. You just need to stop depending on the outcome for validation. One of the most effective techniques I've learned is what I call neutral thinking, a concept borrowed from sports psychology. Neutral thinking means you don't label a trade as good or bad. You just see it as data. You don't get high on wins or low on losses. You simply ask, did I follow my plan? If yes, it's a successful trade, regardless of the result. I once met a trader who kept a decision journal. After every trade, he didn't note the profit or loss first. He graded himself on discipline. Did he enter where he planned? Did he follow his rules? Did he avoid impulsive decisions? That single habit turned him from an emotional roller coaster into a consistent performer. Because when you focus on process over profit, the profit starts to take care of itself. You might be wondering, how do I train myself to execute without emotion? The answer lies in system-based decision-making. Build a system that removes thinking at the moment of execution. You do the thinking before the trade, not during. When your plan is clear, your actions become automatic. You're not deciding under pressure. You're following a script. A professional trader once told me, if your system isn't boring, it's not ready. That hit me hard, because we all love the excitement of trading, the adrenaline, the rush, the action. But that same excitement is the enemy of consistency. Boring trading is profitable trading. When you remove the emotional highs and lows, you make space for logic, patience, and precision. Sometimes emotional execution isn't just about fear or greed. It's about external influence. Social media, telegram signals, or even other traders' opinions can cloud your judgment. You see someone post a huge profit, and suddenly you question your method. You force trades to catch up. That's not trading. That's comparison. And comparison in trading is poison. The only competition you have is the trader you were yesterday. There's also the mental fatigue aspect. When you trade tired, stressed, or distracted, your brain becomes more emotional. Neuroscience shows that decision-making shifts from the prefrontal cortex, logic, to the amygdala, emotion, under stress. That's why tired traders revenge trade, overtrade, or ignore their stop losses. Your brain literally loses its ability to think rationally. The solution? Trade less, rest more. Quality over quantity always wins. If you want to build emotional control, you need structure outside trading too. Regular exercise, good sleep, and mindfulness training improve self-control. Meditation isn't about spirituality here. It's about awareness. It teaches you to notice thoughts without acting on them. That's exactly what trading requires. You can't stop emotions, but you can learn to watch them pass without reacting. Another thing that helped me tremendously was using pre-trade routines. Before every session, I'd review my plan, check my key levels, and write down exactly what conditions must align before I take a trade. If nothing aligns, I don't trade. Simple. That clarity eliminates 90% of impulsive decisions. It's like a pilot checklist before takeoff. Professionals don't rely on gut feeling. They rely on procedure. When I started focusing on execution over emotion, something incredible happened. My results stabilized. I wasn't making a fortune overnight, but I wasn't losing sleep anymore either. Trading became calmer, more predictable, and almost mechanical. My confidence grew, not because I was winning every trade, but because I finally trusted myself. And that's the ultimate goal. Not to control the market, but to control you. So here's the truth most people avoid. Your trading success has less to do with your strategy and more to do with your self-awareness. You're not battling charts or algorithms. You're battling impatience, fear, greed, and ego. Every time you choose discipline over impulse, you're one step closer to mastery. Trading without emotion doesn't mean trading without passion. It means passion is expressed through precision, not chaos. It's the quiet confidence of knowing your process, not the loud excitement of chasing wins. If you're serious about becoming a pro trader, your first step isn't learning another strategy. It's mastering yourself. Because when you can stay calm in chaos, when you can follow your plan through uncertainty, and when you no longer let a losing trade define your worth, that's when you've truly reached emotionless execution. And once you reach that point, the market stops controlling you. You start controlling your future. Chapter 5. Build your system. Not your luck. A trader without a system is a gambler with Wi-Fi. Let's be honest, most traders don't really have a system. They think they do. But what they actually have is a mix of half-learned strategies, random YouTube advice, and a ton of wishful thinking. One day they're trading breakouts, the next day they're scalping reversals, and by Friday they're staring at their charts wondering what went wrong. I used to be that trader. I thought if I just kept learning new strategies, eventually I'd find the one that never failed. So I kept adding indicators, tweaking setups, switching timeframes. Anything to make sense of the chaos. But what I didn't realize back then was that I didn't need a better strategy. I needed a system. A trading system isn't just about where to buy and sell. It's about creating a structure that removes randomness from your decisions. It's the difference between trading emotionally and trading professionally. A professional doesn't wake up wondering what to do today. They already know. They have rules, a checklist, and a process. That's why they win consistently while others rely on luck. Think about it like this. If you open a restaurant, you don't guess your recipes every day. You follow a system. You know how much salt, how long to cook, and how to present the plate. That's how you deliver consistent quality. Trading is no different. If you want consistent results, you need consistent actions. When I first realized this, I sat down and asked myself a simple question. If someone else had to trade for me tomorrow, what exact steps would they follow? I didn't have an answer. That's when I understood I was gambling, not trading. So I decided to build a system that fit me, not someone else on the internet. The first thing you need to understand is this. Your system must align with your personality. There's no best strategy. There's only the one that fits you. If you hate sitting in front of charts all day, scalping isn't for you. If you enjoy analyzing patterns and being patient, swing trading might suit you better. Trading styles are like diets. They only work if you can stick to them. I remember a friend of mine who tried to copy a famous scalper. That trader made thousands of dollars daily, so my friend thought, if he can do it, so can I. He stayed up till 3 a.m., staring at the 5-minute chart, trying to catch moves. Within a week, he was exhausted, emotional, and losing fast. He didn't fail because the strategy was bad. He failed because it didn't fit his psychology. That's why step 1 in building your system is understanding you. Are you patient or impulsive? Do you prefer high-frequency action or slower, planned setups? How much risk are you truly comfortable taking? If your system doesn't fit your natural tendencies, you'll never stick to it. Once you know yourself, you can design your framework. Every good trading system has 5 key parts: setup, entry, stop-loss, target, and risk management. But the secret isn't in finding these individually. It's in how you combine them into a repeatable routine. When I built my first working system, it was boringly simple. I traded only one pair, one time frame, and one pattern, the breakout pullback. Same setup every day. The first few weeks, it felt restrictive. I wanted more trades, more excitement. But after a month, something magical happened. I started seeing patterns in my own data. I could see which days worked best, what time of day had fewer fakeouts, and what conditions increased my win rate. That's when trading started to make sense. Because here's the truth. You can't improve what you can't measure, and you can't measure what you don't repeat. If every trade you take is different, how will you ever know what works? That's why pro traders look boring. They repeat the same setup 1,000 times because they know exactly what to expect. Consistency builds confidence. Now, let's talk about backtesting. The tool that turns your system from a guess into a weapon. Backtesting isn't just running your strategy through old charts. It's building belief. When you see your system work over months or years of data, it gives you confidence to execute during drawdowns. That belief is what keeps you from giving up after 3 losing trades. But here's a mistake I see often. Traders curve fit their backtests. They tweak settings until the past looks perfect, then wonder why it fails in real time. The goal of backtesting isn't perfection. It's probability. You're looking for consistency, not magic. You want to know, does this system give me an edge over 100 trades? That's how you think like a pro. Another key part of building a system is risk management. It's not the exciting part, but it's what keeps you alive. Most traders blow accounts not because they're wrong, but because they bet too much when they're wrong. Your system must define exactly how much you risk per trade, 1%, 2%, whatever fits your comfort. The goal isn't to avoid losses. It's to make sure losses don't hurt your ability to play the next game. Let me share something that changed how I trade forever. A mentor once told me, every trade is just one of the next 100. That single sentence shifted my entire mindset. I stopped caring if a single trade won or lost. My system wasn't designed to win every trade. It was designed to win over time. Once you truly understand that, your emotional attachment to each outcome disappears. Building your system also means defining your trading environment. Where you trade, how long your sessions last, when you take breaks. All these affect performance. If you're trading tired, distracted, or emotionally drained, even the best system won't save you. Create an environment that supports focus, clean charts, minimal noise, fixed trading hours. Professional trading isn't random. It's structured down to the smallest detail. One major mistake traders make is constantly changing systems. You lose a few trades, panic, and start looking for a better method. But what if your system wasn't broken, just untested long enough? Pro traders stick with their setups through losing streaks because they know drawdowns are part of the game. The amateur gives up too soon, never collecting enough data to truly see the edge. Think of your trading system like a business. A business doesn't close after one bad month. It analyzes, adjusts, and keeps operating. Your trading system should be the same. Review performance monthly or quarterly, not after every trade. That's how you think long-term. There's a saying I love. Amateurs focus on profits. Professionals focus on process. Your system is your process. Every rule, every checklist, every backtest, they exist to protect you from yourself. Because let's face it, when money's on the line, logic fades fast. A written system keeps you accountable. It reminds you what to do when your emotions scream otherwise. I remember a time when my system told me not to trade because volatility was low, but I was bored and decided to just take one quick scalp. I lost half my week's profit in that single moment. That's when I realized discipline isn't about doing more. It's about doing only what's necessary. Your system isn't a cage. It's your protection from chaos. Over time, your system becomes a reflection of your identity as a trader. You'll know your favorite setups, your risk tolerance, and your psychological triggers. You'll know when to trade and when to walk away. It becomes muscle memory, calm, repeatable, and effective. Another layer most traders overlook is reviewing trades. After every session, write down what happened. Not just the numbers, but your behavior. Did you follow the plan? Did emotions interfere? Did you exit early or move stops? Over weeks, you'll start to see patterns in yourself. You'll identify where your discipline breaks and fix it. That's how you evolve from a system user to a system master. Now, let's talk about flexibility. A good system isn't rigid, it's adaptive. Market conditions change, volatility shifts, trends evolve. The best systems are simple enough to survive those changes. Complexity kills flexibility. The simpler your rules, the easier it is to adjust when needed. Here's an analogy. Imagine your system as a car. The market is the road. Sometimes it's smooth, sometimes bumpy. You can't control the road, but you can control your driving. You maintain your car, adjust speed, and keep your hands steady. That's what your system does. It gives you control in an unpredictable environment. Eventually, trading with a system becomes liberating. You no longer feel anxious or impulsive. You don't wake up wondering, will today be a good day? You just execute. Some days you win, some you don't. But every day you move forward. And that consistency compounds. Not just in profits, but in confidence. I've seen traders transform their lives by simply following one rule. Stick to the system. One trader I mentored had lost money for 2 straight years. When I reviewed his trades, I noticed he kept jumping between strategies. I made him pick one setup and trade it for 3 months straight. No exceptions. The result? His equity curve went from chaos to upward stability. Not because his edge was perfect, but because his execution finally was. So, when you hear someone say, trading is a numbers game, understand what that really means. It's not about random luck. It's about statistical edge, executed through a repeatable system, over hundreds of trades. That's how you shift from gambling to professional performance. And here's the beautiful irony. Once you build a solid system and trust it, trading actually becomes easier. You stop forcing trades. You stop overanalyzing. You stop chasing. You just show up, follow the plan, and let probabilities do their job.